Have you ever wondered if your investment portfolio, once perfectly set up, just stays that way forever, or if it naturally changes over time? When portfolio allocation drifts, it means that the actual percentages of different assets in your investment portfolio have moved away from your original target percentages. It is a common occurrence in investing, and understanding it is key to maintaining your financial strategy. This drift happens for a few main reasons. First, and most commonly, different investments perform differently over time. Imagine you start with a portfolio of 60% stocks and 40% bonds. If the stock market experiences a strong period, your stock investments will likely grow at a faster rate than your bonds. This natural growth means that your stocks could soon representing, say, 70% of your portfolio, while your bonds would shrink to 30% relative to the total value. This shift in proportions is what we call drift. Secondly, regular contributions or withdrawals can also play a role. If you consistently add new money to only one specific type of asset, that asset class will gradually increase its proportion compared to others, even if market performance stays flat. It is important to monitor this because your initial target allocation was carefully chosen to match your personal risk tolerance and long-term financial goals. When your portfolio drifts significantly, it might no longer align with that risk comfort level. For instance, if your stocks now make up a much larger portion, your portfolio could be exposed to more volatility and potential loss than you are comfortable with. Conversely, if more conservative investments like bonds grow disproportionately, you might be missing out on potential growth opportunities needed to reach your goals. To identify if your portfolio allocation has drifted, the first step is to regularly check your current asset percentages against your original, desired target allocation. Most online brokerage platforms offer a clear, visual breakdown of your current investment holdings, often represented as a pie chart or bar graph. Take a moment to compare these actual percentages to what you originally aimed for. For example, if your target was 60% stocks and 40% bonds, but your current view shows 70% stocks and 30% bonds, you have clearly experienced a drift. A helpful practice is to establish a tolerance band, perhaps 5 or 10 percentage points either way, for each asset class. This means you would only consider taking action if an asset class deviates by more than that set percentage. This prevents you from making constant, minor adjustments and saves on potential transaction fees. The strategic action you take to correct this drift is called rebalancing. Rebalancing involves systematically selling a portion of the assets that have grown larger than their target weight and using that money to buy more of the assets that have become smaller. This disciplined approach ensures your portfolio consistently aligns with your chosen risk profile and long-term financial objectives. It helps you to essentially buy low and sell high in a structured manner, preventing your portfolio from becoming overly concentrated in any one investment that has performed exceptionally well. Think of it as gently steering your investment ship back onto its intended course. Understanding portfolio drift and knowing how to efficiently identify it are incredibly valuable skills for any investor, especially students building their financial foundation. By regularly reviewing and, when necessary, rebalancing your portfolio, you actively ensure it continues to support your unique financial journey. This proactive approach helps you stay on track to achieve your wealth-building goals, minimize unintended risks, and make smart, informed decisions about your money.